Forget what you've heard around the braai, forget what your friends have told you about trusts, about having one, about what makes it cool. Today we're going to demystify all of that for you. Welcome back to another episode of the Enough Club. I am Bryan Nicol.
I'm Pieter Villiers.
So to start off, the first thing is the trust. The trust has been bandied about a lot in conversations, especially lately when people maybe that we have approached us, they've received a windfall, their company's doing well and they're making a lot more money. And so they'll speak to people and people will say, you know, what you need is a trust. And they say, why? Oh, you've got to have one. So we get queries a lot here at Freedom Financial Planning about this. People say, you know, I need a trust. Can you help set one up? So today we're going to try and understand what the fascination with trusts is. And also later on, we're going to unpack why trusts aren't what they used to be. So firstly, I'm going to hand over to you, Pieter, and I want you to unpack a little bit about what a trust is.
Thank you, Bryan. So a trust essentially boils down, like if we rewind a little bit back in the day when people had to go to war, they kind of had, you know, their little farm and their household stead and stuff that belonged to them. And when they went to war, they trusted someone else to take care of that. That was kind of back in the day where the word trust actually came from. You know, I put my trust in someone else to take care of my belongings for my family when I'm not here. Now, over different periods and decades and time, it has now become formalized in a type of structure that we can take out or that we can create to protect our assets. So essentially what a trust boils down is when you own things in your own name, your personal capacity, you know, property or investments, cars and all of that, then it becomes part of your personal estate. If you die, it falls within your estate and there's a lot of taxes involved and costs. So a trust basically boils down is when we transfer our assets into a different entity that we hand over control to what is known as a trustee. That is the 2 or 3 or 4 people appointed to take care of that manage that property, we call it, for the benefit of the beneficiaries. So practically, let's say I've got 4 properties that I own and an investment share portfolio. I can then create a trust and I can then say, all right, well, I transfer all of this into the trust. I appoint 3 trustees to manage this. It could be me, it could be an independent person, it could be a family member. And then I can appoint myself, my wife, and my kids as the beneficiaries of that trust. And what will then happen is it will fall outside of my personal estate. There's a lot of advantages to that we'll cover in a second. And it basically then boils down to it is a different form of protection of what you would have owned in your own hand. And nice thing about that is all the growth that then happens with those types of assets will be outside of your personal name, and that has a lot of potential tax benefits. Now, we get 2 main types of trusts. We get a discretionary or inter vivos or family trust. This is a trust that you will create whilst you are still alive. So typically, if you feel like, you know, if you want to start an investment property portfolio or you have a lot of assets, you're a high net worth individual, you're concerned about what will happen to those assets in your personal estate, you create the trust while you are alive. Or you also get a testamentary trust. This is now, if you were to pass away, you've got minor children. In South African law, if you pass away and you bequeath your assets to a minor child, that will not really go to them. It will go into the Guardian's Fund, which is managed by the government. So you create a testamentary trust, which has trustees appointed to manage those assets on behalf of the minor child until they reach the age of majority or until such time that you feel like they're adult enough to take care of themselves. So those are the 2 main ones. Most people will focus on the discretionary trust to kind of build their wealth, and a testamentary trust is more to protect, you know, minors or maybe someone else in the family, a person that's disabled. The trustees can help to manage the funds on behalf of that person to make sure that it's properly administered by a professional. So maybe, Bryan, share some advantages. Why would one consider opening a trust?
Okay, cool. Before I get into that, I just want to jump onto what you said and add 1 or 2 more points. Well, you kind of did cover it, but I want to stress a few points about a trust. Firstly, when you create this trust, it's like creating a company. It's a separate entity, right? Just like you said, Pieter, but something to wrap your mind around is that when you put things in the trust, it is no longer yours. it belongs to the trust. So it's outside of your estate. So you might have some control over it because you're one of the trustees of that trust. So you sit on the board of trustees, you help make decisions, and so you're able to control things within the trust. And then you still receive income or capital from the trust because you're a beneficiary, right? But at the end of the day, it is not yours. It is the trust's now. So it leaves your bubble, it leaves your space, it leaves your estate, and it goes somewhere else. That's very important because the language often people use is my trust. I got my house in the trust. I've got whatever. It's tricky language, especially if you're audited by SARS. If you use that language, they will say, oh, this isn't really a trust. We'll get onto that later on. But that's just the one thing I wanted to mention. Now, when I said that it is no longer yours, it leaves your estate, that is actually one of the advantages of a trust. You get something called estate freezing or estate pegging. Now, what that means is if you know your estate's going to get quite large, you can, by putting your assets or your estate or whatever into the trust, you can let the future growth of that estate happen in the trust. What's the why? Why would you want to do this? So let me think of an example. If, for example, I have a business and I'm starting to get paid out from shareholding, someone's buying me out over, say, 10 years, and every year I know I'm going to get 4 million rand. I mean, this sounds amazing. I'm getting excited about it. But so 4 million rand every year comes into my bank account. They're paying me out. It's a slow burn buyout over a decade. I know that firstly, I'm going to get a heck of a lot of money. And secondly, I probably know me and my family will have enough. We will have enough. We will be able to live a nice life. But now I'm young. So if this money is invested in my personal name, say it all ends up being 40 million I'm paid out. Every year, every 3 or 4, let's just say every 5 years, it doubles in value potentially if it's invested well, or every 6 or 7 years, it doubles in value. Then what happens is now 40 becomes 80 million, becomes 120 million. Now, in South Africa, we have a terrible tax called estate duty. Estate duty is a tax you pay for the privilege of dying in South Africa. So if you die in South Africa, 20% of your estate, your estate, if I can just kind of say that again, if you die in South Africa, you have to pay 20% tax on the value of your estate. The first 3.5 million rand of your estate, you don't pay tax on. It's like an abatement. It's like an allowance. So 3.5 million, you don't pay tax. Up to 30 million, the rest is taxed at 20%. Then everything above 30 million in your estate is taxed at 25% flat. Now, you can leave things to a spouse or whatever, and then you don't pay estate duty. But at the end of the day, you will pay estate duty. It's inevitable. So what you can do is you can say, fine, I've got this 40 million rand. What if I put it into a trust? Now, the mechanics of this we'll go into potentially later or in a future episode. But just the principle I want to explain. If you put that 40 million rand into a trust, whether it's in one day or whether it's over a year, what happens is you have a loan account. The trust owes you technically 40 million rand. That loan account is an asset in your estate. But that loan account need not grow. So the estate duty payable, if you pass away the next day, is calculated on the 40 million rand. However, in the estate now, that money is there forever. And say you don't pass away the next day, say you pass away in 20 or 30 years' time, the capital you put into the trust, which was 40, is now 250 million. But you still only pay estate duty on the 40 million. Now, I used big numbers for a reason, and it's because this is relevant to people who have big numbers to work with. Smaller numbers, there's other strategies. So that's the first benefit. Another benefit, and then I'll ask you to fill in the blanks, Pieter. Another benefit is a trust doesn't die. Okay, so people die. I will die one day. I'm quite sure of it. And so if I die one day, that means things will happen. My estate has to be wound up. Assets have to go to other people via executors and so on. So there will be frozen assets in my estate. My business shareholding, the shares are kind of frozen in a sense. The business, if I don't have a succession plan in place, the business is at risk. So what you might have is a situation where you have potentially a family business, or you have something that you don't want to be halted just because you have passed away. So any sort of going concern you could potentially have in a trust, And you don't have to worry about waiting 3 years for the executors and everybody to do their job, for that money, for that in business or whatever, the shareholding to pass on to your heirs. Trusts don't die, so you don't have to worry about that. You also don't have to worry about the taxes associated with that at all. So that's just two broad, I mean, there's big picture. We're not going to go into too much detail on this, but that's two big picture reasons of why you have a trust. Is there anything else you can, that comes to mind, Pieter?
Yeah, I think it's a very important point you made is the way that you transfer assets to the trust is important to understand, because you can kind of have one of two ways. It's either you sell the assets to the trust on a loan account. So like you said, like I've got a 4 million property, I sell it to the trust, and now there's a 4 million rand loan account. So trust owes me 4 million. And now if that property grows to 8 million, that growth is within the trust. It falls outside of my estate. But that 4 million still is part of my estate. So if I were to die today, that 4 million will still be within that. So that's why we say it's estate pegging. They use the word, because you kind of you peg it in the ground. Like, all right, this is the value that I stop it today. So all the growth, the capital gains taxes that I might pay eventually will then be in the trust, and the trust doesn't die. The other way is to actually just donate. So there's no loan account. You just say like 4 million goes into the trust. But, Sasha also knows about that. There's no way closing all the loopholes. So then you pay donations tax, which is basically just a synonym for estate duty. Just estate duty before you die, basically. It's same 20% up to 30 million, and then 25% above that. And you have 100,000 Rand per year that you can donate tax-free. If you're married, you can donate to your spouse, and they can also donate. You donate to your spouse tax-free, and they can also donate 100,000. So essentially what that means is if you create a living trust, inter vivos family trust, you can essentially donate up to 200,000 Rand per year tax-free into the trust, and then that capital can be used to buy property or to open investments and all of that. Also, if you have a loan account that you sold it to, you can use that donation to offset that. Another technicality with that is, don't think now, it's easy. I'll let the trust go on a loan account and then I just won't charge any interest on the trust. There's a rule around that. There's a specific interest rate that the trust needs to charge you, or that you need to charge the trust rather. Otherwise, that difference will become a ongoing donation. So a trust can get quite technical, and that's why when you do follow this route, you need to make sure you do it the right way. What you mentioned with, if you don't hand over control, it becomes an alter ego. That means that if Sash comes and audits you and you transferred a lot of assets to the trust, but you basically bullied all the trustees and you just dictated what needs to happen, that might as well just become your own assets again when you pass away. And now you're sitting with that estate duty problem. Potentially, if there's a divorce order, a maintenance claim, creditors can come attach, all of that. So all of the benefits that you thought you created vanishes because you didn't do it the right way. There's also another type of like nuance. It's called the sham trust. If the trust wasn't actually created, there was no intention to actually create the trust. It was just like you said, like it's my trust, but it doesn't really exist. So just be careful if you do go down this route. It's very important that we do it the right way. But the creditor protection, if you move it out of your estate and you've got a business that went down and someone tries to sue you, your assets are in the trust, they can't attach that. There's no estate duty when you pass away, executors fees, capital gains taxes. You save a lot on that. And the other benefit that we can touch on is, let's say you do have a rental property portfolio in the trust and it does earn rental income, and it's you, your wife, and your children as the beneficiaries. You can actually split that income to like 3 or 4 people, and then you would be taxed in your own name. They call it the conduit principle. Conduit is basically like, think of it like a pipe. It goes through in one direction. So instead of the trust being taxed at 45% on that rental income, it pays out to, let's say, you and your wife, and then you get paid in your taxes in your personal capacity, where you've got the different types of income tax rebates and medical aid tax credits and all of that, interest income exemptions. So that's a nice way of actually distributing the income to lower the ultimate tax liability, with the caveat that if there's a loan account, then you as the founder might actually be liable for that. So I don't think we're going to go too technical in that today, but just note that when the advantages that we list here is given that the trust is properly set up. And if you don't, then it's the flip side, the disadvantages. So maybe Bryan, you can dig into that. What might go wrong if we don't do this in the right way?
Yeah, there's a lot that can go wrong. And a lot of it is firstly stemming from regulation and tax. In the past, people viewed trusts as a tax mitigation strategy. So you created a trust and it was a way to avoid tax, if I can just put it bluntly. Pretty much all of the laws that have been put in place on trusts over the last, say, decade and a half, they've been put in place to close those loopholes. So that is why at the beginning of the episode, I said that trusts are no longer what they were. It's because the loopholes have been closed for tax mitigation to a large degree. Now, what this means is you might put money into a trust, you might have a soft loan. So you might have a very low interest rate, a rate that is lower than the official rate of interest that a trust must charge someone who puts money in it who has a loan account. The official rate of interest for your interest is the repo rate plus 1. I think at the moment that's like 7.75%. So if you put R1 million in, 7.75 is 77,500 Rand interest should get paid back to you every year. Now, there's ways of putting money in there, and in essence, there's 4 different things you can do with a loan account. There's 4 different ways you can get money in there, and what we would do with clients is do a feasibility study. We do calculations because you can donate the interest, you can waive it, you can say, I don't want the interest. Then you pay donations tax on the interest. You can then say, I want to receive the interest, and it gets taxed in your personal, according to your marginal tax rate in your personal name. You can kind of look at all the options, and then you would work out what is the least painful, but also which option helps solve the problem that you're trying to deal with. So if you want to peg your estate, you don't want your loan account to get larger and larger. So if you say roll my interest up, in other words, now you owe me the 4 million I put in this year plus the interest on it, or the million I put in this year plus the interest, your loan account grows every year. And then the interest is on that interest previously, so it's actually compounding. So you're not really shrinking or pegging your estate, rather, you're growing it. So that's not always an option for someone, but that might not have been the reason why they set up the trust. And so that might be an option for that person. So there's various pitfalls there, because what happens now is if you do that wrong, the mechanics of it, if you do it wrong, if you're not on top of that with your accountant and you don't understand what you're doing when you set this up, you can be found liable by SARS. And then they will ask for backdated taxes with penalties. And if they find it 15 years after the fact, there's no charity there. They will just want what they need. So that's the first problem. Another challenge I've found with people is they would say, okay, let's set this trust up. We put things in it. We do it the right way. Yes, there was a donation maybe. And then they say, we donated a property. We have a commercial property. We had it in our personal names. We now want to put it into a trust. This commercial property has tenants. We get a rental income. I want to distribute it to my children. My child is 3 years old or 5 years old. So if this is now income, they can earn probably around about 96,000 Rand a year before they start paying marginal tax, at 18%. So now that sounds great. So you do that. But now you don't actually distribute money to the child. So that's fine. You can do it on paper, but at some point in time, that money must go to the child. Now, if you never distribute the money to the child, and the child's 18, 19, learns what's happening, they can actually sue you for all the money that's owed to them. Secondly, if you do have donations, a soft loan or a donation that you've made that you're trying to get around. So if that capital you put in, if it generated income and you distribute to the children, I think it's section 7.3 of the Act, it will just be taxed in your name as the parent. So you're not really solving that problem. SARS will go and draw a diagram and connect the dots and be like, no, you pay tax on that. And it gets taxed in your personal name. And then it adds to your tax burden. So you've now don't have the money necessarily, it's in the trust, but now you've got to pay. So now if you want the money from the trust, you got to get it back out. And it creates these challenges. And so people can literally go cross-eyed thinking about where are they with the trust and the loan accounts and that. So we would always say go as simple as possible and understand the mechanics of it and realize that whenever money leaves your estate and it goes somewhere else, whether it's a trust, whether it's anyone but your spouse. Wherever money leaves your estate, tax is due. Let's just do it in the smartest way to make it the least amount of tax. If you get greedy, you're going to get hurt. And SARS are focusing on trusts all day long. So the biggest pitfall is falling foul of the law. That for me is a massive one. And then also not understanding potentially the ramifications of distributing income, who is liable for income. The trust deed will determine that. The trust deed is the law, the 10 commandments that rule the trust. And so you've got to write that thinking about the family dynamics. You've got to write that thinking about who all is a beneficiary. You've got to write that with a professional. We don't even get involved with writing that. That is a lawyer or a trust officer who will do that. There's various ramifications. We can't get into it. I can talk about calculations, about how to go about reducing tax, but that's a very in-depth topic. So now what we're going to do is, firstly, I want to look at who should maybe not have a trust. And so who should not have a trust? It's probably going to be average guys. When I say average, probably middle to high income earners, potentially employed somewhere. You don't have your own business. You're getting money from a salary. You're investing it. You're building up a portfolio potentially, but it's not overwhelmingly large. And estate duty and estate planning considerations are not your biggest problem. You have to consider intergenerational wealth transfer. In other words, you think you might die with 20 or 30 or whatever million rand extra, but with the goodwill or maybe specific products that you have in place that can get to your children or your spouse pretty smoothly. A trust is not for everyone. It's definitely not for a lot of people who I think are employed, a lot of people who don't have hectic net worth. So if you're like probably under 40, 50 million even, it might not be worth it. If you're married, you can pass things on to your spouse pretty quickly. You need not worry about it. But it definitely does have a place in this world today. So Pieter, in your experience, who should consider a trust?
Yeah, I'll add to that. I think when doing research on online, just be careful of all the advice out there, because what I always say, if you watch a video or you consume a piece of content, always understand what is the narrative behind that. What is the action that's trying to be driven. So, for example, if you watch a video of someone saying everyone should have a trust, like it's a no-brainer, paying taxes is bad, just open a trust and you're not going to pay everything. Obviously, apply your mind, apply logic. It's probably they sell some sort of service with an open trust. So I agree. I think for most people, a trust won't make sense. Maybe 20 years ago, it would have been, because the rules were much more relaxed. But almost every year, SARS implements new rules to close loopholes of loopholes of loopholes. There are many regulations pending on trust that's going to make it even more difficult to really see the benefit of using them. So as a starting point, for most people, probably won't make sense. But there are obviously cases where it does. So for me, I think, if you do have a lot of wealth, and for you, life has extended past the point of just taking care of myself, for me and my wife, I've got enough wealth I want to pass on to my children and even my children's children, third generation, then a trust absolutely could make sense, because then you don't want your money to die with you. Moving it to the trust, there has to be some proper calculations done, because there is a lot of costs involved. There's potential capital gains taxes, donations taxes, transfer duty, lawyer fees, so all of that has to be taken into account. But for your ultra high net worth families, like you said, above 50 million, it's probably going to make sense. Trying to spend 50 million in your lifetime is going to be tough. So it's probably better to transfer that and preserve. And people that wants to pursue investment properties, I think there's also a good argument to be made that that's a good place to start off. There's different types of strategies you can follow. It could be one trust that owns a property company that owns the property, or it could be a family trust and a holdings trust with a property company with the properties. Different strategies. I think it always boils down to how complex do you want to get, and how much is that going to cost you in time and effort and sanity. So those type of structures, because property is an asset that you can leverage, and when you take out a loan in your own account, in your own name, you are limited to the amount of debt you can actually leverage. So that type of structure could make sense where you buy multiple properties. Great stuff. And if you start with your first couple of properties in the trust, it's better than to build up a big portfolio outside of the trust and then trying to transfer it over, because again, there's the costs involved. That is, if you do want to play the property game, it's not as passive as it's made out to be. It can get quite complicated, but that could make sense. And maybe some entrepreneurs that's building big businesses where they take a lot of risk. There's heavy plays, and you concerned that if your ventures goes down the drain and you get sued, that your family's wealth is not at risk. Then opening a trust and putting your business into that, and maybe a separate trust for your personal belongings could make sense. But it has to make sense from a cost and complexity perspective. And then what I mentioned earlier, if you have a minor child less than 18 years old, that's almost like a no-brainer. In your will, nominate a testamentary trust to take care of that child, and then you can nominate a type of fiduciary company to be the trustee with a family member as a co-trustee, because they won't be able to receive that funds. It's going to pay into the guardian's fund, and good luck with that. That's not a good outcome. So I think that for those individuals, those families where you run the numbers and you're like, all right, well, I've got a lot of wealth. I want to protect it. I want to keep it outside of my estate, and manage it, or appoint people to manage it on behalf of my family members that I might not necessarily trust. If I pass away and everything goes to their name, they're going to spend it all. That could also be a reason, and that's something again with the testamentary trust that you can consider in your estate planning exercise.
Yeah, when you mentioned, just for anyone watching or listening to this, when you mentioned the guardian's fund and why it's not a good idea, just to give context, if you don't make provisions for your minor children, so say you're a husband and wife and you've got 2 children, and now you pass away together, and it unfortunately rarely, but it does happen that might be the case. And so if that happens, you've got 2 children who are now orphaned, and if you haven't got a will that makes provision for a testamentary trust, so in other words, all of our estate, all of our assets goes into a trust, people will look after it for our children until they're old enough to do their own thing. If you don't have that in place, it pretty much goes to the government. And so the government will manage that money for you. I'm not going to say anything on here that can get me in trouble, but you can decide for yourself how wise that is. Or you can get a will drawn up and just have that provision put in, which is very much cut and paste. It's so basic. And that's why wills are so important, but that's a story for another day. So what I want to do is I want to bring this, maybe close off with a real example, bring it home with a real example of a client we worked with not so long ago on a wealth audit. So we have something called a wealth audit at Freedom Financial Planning, which is like a once-off financial plan, either for DIYers looking for some guidance or for clients who first want to sample the goods before committing to the long term, so to speak. And so this client approached us and had spoken to a few other advisors who kind of did some planning and suggested some products and investments and such. And while working with her in this planning process, the client said that another advice firm, a wealth management firm, said that the money that they've got in their estate, it definitely needs to go into a trust. And what they can do is set up a trust for them and manage it like that. So I asked if they gave reasons why that was, and they just said no. Apparently, the client said no. The advisor said it's a lot of money, tens of millions, and therefore it needs to go in a trust. Now, let's look at this in context. And based on what you've heard us say, you can decide for yourself if this is trustworthy or not, this scenario. So what happened is this person is 60s, single, got 2 children who are, I think, in the 30s. So adults, got families, whatever the case may be. Now, yes, there's a fair amount of wealth there, but the wealth is now the retirement pot. So this person is what we might refer to as in the consumption or decumulation stage of their life. They're no longer building up assets, they're consuming assets, and we need to make sure it lasts deep into 100, 120 years of age. Now, to move all of that into a trust is expensive. It's going to be tax, unavoidable. It's going to be tax, estate duty or whatever. The capital might grow into the future. Hopefully it never stops growing. But realistically, it's going to be consumed, a big chunk of it, until the client passes away. So it didn't make sense to me for this person to have a trust, because they're not pegging their estate really. If you look at their life expectancy, that's not really an estate pegging exercise, unless this advisor knows something I don't about when this person's going to die. So what I did was I went onto the advisor's site, and I went onto the website with the client, shared a screen, typed it in, and there, big on the main landing page was, we offer trusts to manage your investments. And so what I realized was, with in-house, they have that offering. And so they then punt that, obviously, to create additional revenue streams. It makes sense. It's their product that they're selling, so to speak. And so you need to know a bit about this, even when you speak to advisors, to understand if you're being set up for something you don't need, if you've been set up to make other people wealthy besides yourself. Trusts are not a joke. It's hard work. There are pitfalls. There are massive advantages, though. So just understand what you need to know about it. And feel free to also reach out if you want to know anything more about trusts. In the comments below, you're more than welcome to also put down your experience with trusts. If you've had one before and had to exit it, why? Was it a good thing? If you've set up one up recently, what's it doing for you? Just share your comments so others can also learn from it. Then I'm going to hand it over to Pieter to give us a little bit of an insight into what we're discussing in our next Enough Club podcast episode.
Yeah, awesome. So now that you guys have a basic understanding of the intricacies around trust, how what it is, how it can be used, advantages, disadvantages. In the second episode, we're actually going to talk about how do you coordinate your personal financial planning, as the individual, with the trust, because it may be a different entity in the sense that we move assets across, but that doesn't mean it disappears into the void. You actually have to think about, how does that trust have to serve you? It still becomes a sort of asset, like you would see your property and your investment portfolio. And how do you coordinate that planning between the two? Because what we've seen a lot is this mismatch. There's someone that manages the trust assets independently from personal planning, and then it really becomes messy and confusing, and something that you took out, or someone that took out the trust on your benefit back in the day, does not really serve you anymore, which is quite sad. So we're going to touch on that. And then in the third episode, we are going to talk about a little bit more about estate planning and what other structures we actually have available that can serve similar purposes as a trust, but that you don't have to go through all the complexities to set it up. So that you ultimately, from our side, we just want you guys to make an informed decision and know the pros and cons on both sides, so that you can decide what best serves you at the end of the day. So I'm very excited about the next two episodes, and we're also going to share a bit more case studies of what we've seen in real life, in practice with you guys.
100%. So thanks very much. I'm so glad I got through that whole episode only using one trust pun. It's a very easy word to abuse. See you next time around. All the best. Keep well. And please do like the video and subscribe to this channel. Have a good one.
Yeah, trust me, you're going to enjoy it.